Hi, welcome to Numerix Video Blog. I'm your host, Jim Jockle. In post-Brexit, as we're still in the week after the aftermath, coming up on the week anniversary, I want to take a look ahead into the FX markets. And joining me today, Vice President of Business Development, Udi Sella. Udi, thank you for joining us.
Hi, Jim. Good afternoon. How are you?
Very good, and thank you. Want to get some of your insights. So, obviously, we've seen the markets roiled, stock prices radically moved as it relates to volatility in the market as caused by Brexit. But however, we're seeing those gains kind of restore. Bonds are kind of still where they were in a negative place, but the interesting argument in the market still remains USD sterling. So, why don't you give us a little bit of perspective of what's going on and what the thought process is around the sterling right now?
Sure, Jim. Thank you. So, indeed, clearly the most or the biggest move was in the sterling, to a large extent against the US dollar, to a little bit smaller extent against the euro, because the euro again weakened a bit against the dollar. What we've really seen is the price adjustment, where given the shelling, if you like, of the Brexit, and the market was caught surprised, right? And we've seen pretty much the sterling weakened by about over 10%. There was a technical correction yesterday and on Monday, on Tuesday and Wednesday, and now the sterling is weakening again to levels of something like 132. Because as the first results came out, or the polling results came out, the sterling actually strengthened towards 150 and then went all the way down. And the interesting thing is that the sterling weakened to a very large degree, the euro to a much smaller degree, and then emerging market currency actually attracted funds and strengthened a lot. As an example, Brazil or Russia.
So let's talk a little bit more about derivative strategies now. So I want to take a little bit of a long-term view, and by long-term, I'm going to peg October, where we're going to see an election process in the UK as it relates to the PM. From a strategy perspective, what would be on your mind, specifically around different strategies?
So actually, Jim, you mentioned October for the UK PM, but of course November will be the US president election. So these two things are major events in the market, and what we've seen basically we saw a very, very violent move, but rather short term. So if you like, we saw almost one adjustment, very violent, rather than a gradual one. And we didn't discuss that, but in a sense also there was, we always talk about the CVA exposure, etc. What we've seen also, we've seen a lot of CVA pain, especially in Europe with regards to European names. And now this is basically, we've seen what they call cross gamma, because there was the CDS spreads opened and the yield came lower. So this is what they call a cross gamma effect. And so I'm mentioning all that because I think that people would like to hedge with out of the money options, those tail risk events, because this is basically you cannot really hedge cross gamma because this is a correlated effect. So you need to hedge first of all, your portfolios, your financial activity, etc. But as a bank, you also need to hedge your CVA exposure. So I would suspect, you mentioned derivatives, so I think out of the money options would come into use, which basically implies also that we will see volatility staying at high levels, and because basically the market is in uncertainty phase at this point in time.
You brought up the U.S. Obviously, some of the initial statements now where the market was starting to factor in a U.S. hike to the USD, but however, now we're starting to see that is not potentially, or may potentially not happen this year. How does that change your thinking from a FX perspective?
Yeah, so if we were saying, even last time we were betting that there will be one rate hike by the Fed in September, it seems to be now off the chart. I mean, not happen, and the market is actually pricing a potential rate cut. So what does it imply? It implies that people would go into safe haven assets like the Swiss franc and the Japanese yen, and indeed the Japanese yen strengthened a lot against the dollar to levels of 102 yens to a dollar. So we may see, first of all, additional strengthening of the yen, and in a derivatives perspective, we'll probably see again hedging to the downside of dollar yen, which means higher risk reversals, negative risk reversals if you like, and higher implied volatility. And of course, which could be, this is something could be a different theme for us to discuss, but the currency war, right? Because the Japanese want to weaken the yen, the Swiss National Bank wants to weaken the Swiss franc, etc., as a competitive advantage to increase and stimulate exports.
So last question for you, Udi. In terms of Europe's always a little bit quieter now that we're rolling into July and August. Within the summer months, trading volumes are always a little bit quieter. So the question is that a help for the markets, or is that just perhaps a boon for volatility?
I actually think more of the latter, because indeed there are less volumes, which makes the market less liquid, and therefore more volatile, because smaller amounts can move the market. And we've already seen during summertime painful moves for the market. So I actually think the market will continue to be volatile. And also if we tie that to capital adequacy requirements, banks hold smaller positions, which means that liquidity is hampered, and thus volatility could be higher. So I think all points for brutal moves.
And I'm going to put you on the spot for a yes or no question. Dollar-pound parity, could it be a reality?
Yes.
Udi, I want to thank you so much. And of course, we want to always talk about the topics that you want to talk about. And we're going to definitely want to get your insights, Udi, as this continues to play out. I think the summer is going to be a fascinating time period, especially as we roll around into the uncertainty within September. And as you also highlighted with the elections in October and November. So, of course, please follow us on LinkedIn or Twitter at NX Analytics. And Udi, thank you so much for your insights.